Welcome to this video where I will cover the book Intelligent Investor by Benjamin Graham. This book is considered one of the most important and influential investing books ever. The author, Benjamin Graham, was one of the most respected investors and analysts of his time, and his book The Intelligent Investor is considered a classic among investment books. In this video, we will cover the basic principles and strategies that Graham describes in the book The Intelligent Investor. These principles are still valid and can help us decide how to invest our money. If you are interested in investing and want to learn more about how to become a smart investor, be sure not to miss this video. Benjamin Graham was one of the most important investors and philosophers in the field of finance and investing. His book Intelligent Investor is a classic among investment books and has become the Bible of many investors around the world. In the book The Intelligent Investor, Graham introduces the idea of value investing, which focuses on finding and investing in stocks that are undervalued compared to their true value. It also highlights the risks of investing and emphasizes the importance of investing in a diversified portfolio. Graham believed that investing should be based on a sound and disciplined approach rather than emotion and speculation. It also emphasizes the importance of researching and analyzing a business before investing. Although the book was written in 1949, its principles are still current and relevant to today's investor. Graham's philosophy of value investing has been successfully applied by many investors and has brought them great success. In short, the book The Intelligent Investor by Benjamin Graham is a must for anyone interested in investing. Graham's idea of value investing and his approach to investing are still very relevant to today's investor and can help them achieve success in the financial markets. Let's look at the individual chapters of the book. 1. Investment versus speculation. Graham is keen to mark out an important difference between investors and speculators. According to Graham, intelligent investing consists of three things: a thorough analysis of a company and the soundness of its business practices before the purchase of any of its stock. Not aspiring to extraordinary results, but aiming for adequate performance. For an intelligent investor, money isn't made simply by following the market, i.e., buying a stock because its value has gone up, or selling a stock because its value has waned. Graham argues that the exact opposite is true, positing that stocks become riskier the more their value increases and vice versa. Whereas an investor believes the market price is judged by established standards of value, a speculator bases all of their standards of value on the market price, which is a significant difference. An excellent way to check if the market is swaying your value judgments is to ask yourself whether you would be happy to invest in a particular stock if you were unable to know its market price. For this reason, it's vital to point out that, unlike the speculator, the intelligent investor isn't investing for quick wins. The only way to reach long-term investment goals is to make sustainable and reliable decisions that are not subject to the whims of the often volatile stock market. 2. Investment in inflation. Nevertheless, just because the future is uncertain doesn't mean that we should put all of our investments in either bonds or stocks purely because of the attractiveness of their current interest rate. The more an investor begins to rely on the income gained from their portfolio, the greater their need to protect themselves from the unexpected. This means investing in the broader spread of both bonds and stocks. Since The Intelligent Investor was first published, two additional investment options have become available that protect investors from the risks of inflation. These are REITs, real estate investment trusts, companies that own and collect rent from both residential and commercial properties. TIPS, Treasury inflation-protected securities, U.S. government bonds that automatically increase in value as inflation rises. 3. A century of stock market history. At the time of writing the updated version of The Intelligent Investor, it was 1973, and Benjamin Graham had managed to predict the disastrous bear market of 1973-74 in which U.S. stocks lost 37% of their value. However, he unequivocally states that the intelligent investor doesn't rely exclusively on historical data to predict the future. To prevent us from taking such a purely historical-focused approach, Graham posits that we ask ourselves the following questions. 1. Why should future returns always match past returns? 2. If each investor believes that certain stocks are guaranteed to make money in the long run, then doesn't that mean that the market will end up becoming overpriced? 3. If this is the case, then how is it possible for future returns to be high? As Graham points out, to use a market's recent good returns as a platform from which to project future returns is risky. No stock can perform consistently well for all time. However, many investors fall into the trap of buying high because a stock seems secure, and then selling low when the stock inevitably falters. Ultimately, Graham states that the only thing an investor can be sure about when attempting to forecast future stock returns is that they will probably turn out to be wrong. 4. The active and the defensive investor. The aggressiveness of your portfolio depends less on the kinds of investments you make, and more on the type of investor you are. Benjamin Graham states that there are two ways to be an intelligent investor. 1. To continually research, choose, and observe a mix of bonds, mutual funds, and stocks. Graham refers to this as the active or enterprising approach. It requires a lot of time and energy. 2. To create a permanent portfolio that requires minimal further effort on your behalf and that runs on autopilot, but that doesn't generate a lot of excitement as a result. Graham refers to this as the passive or defensive approach. Both approaches are equally smart, but your success in either one of them requires you to know which approach better suits your personality. 5. The defensive investor in common stocks. One of the biggest challenges that a defensive investor must combat is the belief that they can pick stocks without doing a lot of research beforehand. It's essential that a sense of familiarity with the company doesn't replace researching the company's financial statements. As psychologists at the Carnegie Mellon University showed, the more familiar an individual feels they are with a subject, the more likely they are to exaggerate how much they know about it. As a defensive investor, it's also essential not to become excited by new market fluctuations that could induce a rash investment decision. The way a defensive investor both participates in and wins the race is by sitting still. According to Graham's dollar-cost averaging approach, a defensive investor will regularly put a fixed amount of money into a particular investment, regardless of how the markets are performing in any given week. 6. Portfolio policy for the aggressive investor, the negative side. Benjamin Graham argues that for both the defensive and the aggressive investor, what you don't do is just as important as what you do. In this chapter, Graham highlights some absolute essentials for those wanting to take the aggressive investor route. These include: 1. Avoiding high-yield preferred stock, as there is no cheap and wildly available method for mitigating the risks associated with such stock. 2. Don't die a trader's death by getting stuck in a vicious cycle of continually buying and selling stocks per the fluctuations of the market. As is evidenced by thousands of investors who have fallen prey to this exaggerated form of aggressive investing, the more you trade, the less you keep. An investor who is unable to hold on to their stocks for more than a month or two is, therefore, doomed to fail. 3. Don't get conned by an attractive IPO, initial public offering, purely because there is a lot of hype surrounding it. The more hype there is, the more likely it's that the stock is overpriced, and the more likely it is that you make a judgment call based on your emotions, as opposed to rational judgment. 7. Portfolio policy for the aggressive investor, the positive side. Graham puts forward 4 ways an aggressive investor will make their investments. 1. Selling in high markets and buying in low markets. 2. Buying carefully considered growth stocks. 3. Buying bargain stocks. 4. Taking advantage of and buying into special situations. For an aggressive investor to make a sound investment, it must further be held accountable to the following 2 ideals. 1. The decision to buy the stock must be grounded in solid reasoning. 2. It must not be popular with most other investors or speculators. Graham suggests 3 investment approaches which conform to this twofold criteria. They are as follows. 1. Investing in a relatively unpopular large company. If we can take it as a given that the market habitually overvalues common stocks that have been showing remarkable growth, we can assume that it undervalues companies that are not performing quite as well. The key here is for the intelligent investor to locate the larger companies that are going through a temporary period of uncertainty. Take, for example, Johnson & Johnson, who in 2002 announced that federal regulators were investigating its books after claims of false record-keeping. This false record-keeping caused its stock to drop a considerable 16% in a single day. Smart investors bought up these stocks. When the company returned to its former standing, they'd made quite a bit of money. 2. Purchasing bargain issues. A bargain issue is a stock or bond that seems to be worth at least 50% more than what it's selling for. To work out if an issue is a bargain, you must first attempt to estimate whether the stock's future earnings outweigh the costs of the issue currently causing it to be undervalued. Secondly, you must evaluate the value of the business to a private owner which, again, is primarily worked out by projecting future earning potential. Graham refers to this approach as having courage within a depressed market by using the wisdom of value analysis. 3. Special situations. A typical special situation arises when a larger firm acquires a smaller firm. To make such an acquisition possible, and to get the shareholders of the smaller company on board, the stocks are nearly always offered at a price considerably higher than the current price. Therefore, any investor smart enough to purchase shares or bonds in a company that is perhaps nearing bankruptcy, and thus selling cheaply, but that may have a chance of being bought out and increasing its stock value, could make a lot of money. 8. The investor in market fluctuations. For the majority of the time, the market accurately prices stocks, but occasionally, the price is significantly wrong. Graham explains why by conjuring up an image of the market as being Mr. Market, a frantic investor who pays too much for stocks when they are doing well and desperately tries to get rid of them when their price falls. It's, therefore, important that the intelligent investor can view the market as a fallible, emotion-driven entity that shouldn't be blindly trusted, even though most people do. While it's undoubtedly a good idea to observe how the market is behaving, the intelligent investor should behave in a way that serves their interests, without getting caught up in the pull of dramatic market fluctuations. Investing isn't about beating others in an investment game, it's about controlling your behavior and being in charge of your own game. If you're planning on investing for at least 25 to 30 years, then the most logical investment approach is to buy every month automatically and to buy more whenever you get some extra money. If stocks are doing well, you buy. If they fall, you buy, and over time, your investments will begin to add up steadily. 9. Investing in investment funds. Though mutual funds make investing seem easy and affordable, they come with their problems. They often underperform, overcharge, and behave erratically. The intelligent investor must, therefore, choose very carefully before investing in a mutual fund. A group of financial scholars that studied mutual funds for half a century concluded that mutual funds tend to behave under the following. They do not choose stocks well enough to cover the costs of researching and trading them. The higher a mutual fund's expenses, the lower its returns. The more frequently a mutual fund trades, the lower its returns. Mutual funds that are more volatile than others and are likely to remain volatile. Mutual funds that had high returns in the past are unlikely to keep these high returns for long. However, armed with this knowledge concerning the fallibility of mutual funds, the intelligent investor is better equipped to discern a more solid mutual fund from a more volatile one. Further, mutual funds offer the intelligent investor an excellent means of diversifying their portfolio and freeing them up to do things besides endlessly analyzing the market and picking their stocks. 10. The intelligent investor and their advisors. Many investors take comfort from the second opinion of an excellent financial advisor. Whether it's to get advice on the rate of returns or to have someone to blame when things go wrong, having an advisor can prove an essential asset in the intelligent investor's arsenal. Indeed, there are specific scenarios in which seeking out an advisor might prove even more beneficial. These include, if your portfolio loses a significant amount of its value. If you struggle to keep and maintain a personal budget and are barely able to make ends meet, let alone begin saving. When your portfolio is over-diversified to the point of being completely chaotic. If you've recently gone through a significant life change, such as becoming self-employed, or if you need to look after your aging parents. 11. Security analysis for the lay investor. It can be challenging to discern which factors determine whether you should be willing to pay for a stock or not, but Graham provides 5 qualities by which to measure the attractiveness of a stock option. 1. The company's long-term prospects. This quality requires the intelligent investor to look at least 5 years' worth of the company's annual reports and to answer 2 questions: where are the company's profits coming from, and what is making this company grow? 2. The quality of a company's management. A good company's management will do what they say they will. They should be honest about their failures and take responsibility for them. 3. The financial strength and structure of the company's capital. Whether the company produces more cash than it consumes, and the managers reinvest this money to grow profits further. 4. The company's dividend record. Research the previous 10 years of dividends history. If dividends have increased at a steady average of at least 6 to 7% over the past 10 years, that's a good sign. 5. The company's current dividend rate. 12. Things to consider about per-share earnings. The intelligent investor is aware of the lengths to which top executives and accountants occasionally go to make themselves very rich at the expense of the company and its shareholders. There are plenty of ways that financial reporting and creative accounting has made companies seem more financially attractive than they are. 13. Stock selection for the defensive investor. By definition, the defensive investor takes a low-risk, long-term approach to investing. The best tool invented for such low-maintenance stock investing is a low-cost index fund. However, some defensive investors do enjoy the intellectual challenge of picking some individual stocks. To help defensive investors make smart stock investment decisions, Graham proposes the following criteria for stock selection. 1. Adequate size. 2. Strong financial condition. Graham defines financial strength as a diversified portfolio of stocks that's current assets are at least double its current liabilities, and that's long-term debt doesn't exceed working capital. 3. Earnings stability. A stock is strong if it has some earnings on the common stock in each of the previous 10 years. 4. Dividend record. Look for companies that pay dividends and that have a history of doing so. 5. Moderate P/E ratio. Only choose stocks whose current price is no more than 15 times the average earnings over the past 3 years. 6. Moderate price-to-book ratio. Multiply the P/E ratio by the price-to-book ratio. If the number is below 22.5, it's likely to be a reasonably priced stock. 14. Stock selection for the enterprising investor. For most investors, picking individual stocks is inadvisable. Even most professionals do a lousy job. While a small percentage of investors do well at picking their own stocks, the majority would do better to invest defensively in an index fund. However, for those who want to give enterprising investment a shot, Graham suggests a practice first, by spending a year tracking and picking stocks, but not investing any money. This way, you learn without incurring any significant debt. After a year, measure your results against how you would have done if you had put your money in an index fund. If you found the process exhausting, or you picked bad stocks, it might be worth considering becoming a defensive investor. If, however, you enjoyed the process and made some good returns, Graham suggests assembling a selection of stocks. If you decide to invest on the market, then you should look for stocks in industries that are temporarily unfashionable and, thus, offer the potential for big gains once the public perception changes. Next, it's essential to look at who is running the company. Above all, an enterprising investor must be both disciplined and consistent, resist changing their approach even when it seems unfashionable, and they should only focus on what they are doing, not what the market is doing. 15. Margin of safety is the central concept of investment. Losing money is an inevitability of investing. To be a smart investor, you need to ensure that you never lose the majority, or all, of your money. To give yourself a buffer, Graham suggests that you refuse to pay too much for an investment and, therefore, minimize the chances of your wealth completely disappearing. As he has repeated throughout the book, the greatest risk to our financial health isn't the stocks, but ourselves. Risk resides not in the market, but in what kind of an investor we are. To check whether your confidence is well calibrated, consider asking yourself the following questions. What is my track record with making similar decisions? What is the track record of other people who've made similar decisions like? If I am buying, it means someone else is selling. How probable is it that I know something that the seller doesn't know? If I am selling, someone else is buying. How probable is it that I know something that the buyer doesn't know? How much does this investment need to go up by before I break even, including taxes and the costs of trading? In conclusion, the probability of you making a bad investment during your investment lifetime is 100% guaranteed. Graham is, therefore, adamant that the intelligent investor has insured themselves against any losses that a bad investment may accrue. Many investors are so sure that they are right, they do little to protect themselves against the consequences of being wrong, and this is fatal for an investor. However, by making sure your portfolio is permanently diversified, and that the fluctuations of the market never influence you, you can ensure that the fallout from your bad investment decisions will never be a total disaster. This means that you can continue investing with regularity, patience, and calm, as you gradually work your way towards your long-term financial goals. If you are interested in multi-level marketing or want to buy some products or support this channel, there is a link on Amway in the video description. If you like the video, give it like, subscribe and turn on the bell. And don't forget money is freedom. And keep learning.